Yeah, good evening, ladies and gentlemen. Thanks for joining us today on the fourth quarter and fiscal 23 earnings call of Tracxn Technologies Limited. On behalf of Systematics, I'd like to thank the management of Tracxn for giving us the opportunity to host this earnings call. Today on the call, we have with us Ms. Neha Singh, co-founder, chairperson, and managing director; Abhishek Goyal, co-founder, vice chairman, and executive director; and Prashant Chandra, chief financial officer. I would now like to hand over the call to Neha to give the opening remarks and present the PPT. And after that, we will open it up for Q&A. Please use the raise hand option to ask the question, or you can also submit your questions in the Q&A box at the bottom of your screen. Thanks. And with that, over to you, Neha.
Thanks, Siddharth. Welcome, everyone. Thanks so much for joining us today for our earnings call for the fourth quarter and the financial year FY23. We are very excited to present our results. In terms of the format, we would like to run through a small presentation, which will share some of the key highlights of the period. I'll also give the commentary along, which will be helpful in the overall understanding. And then we'll follow it up with a Q&A session. Request you to go through the standard disclaimers for this presentation. Quick recap on our business. Tracxn is a data and software platform for the private markets globally. If you look at the public markets, it has created multiple large companies, many of which are highly cash-rich, profitable companies. As private markets are becoming large and important, it will also create platforms like these, and we are building a global platform in this space. Our customers include venture capital funds, private equity funds, investment banks, as well as M&A teams, innovation teams of large Fortune 500 corporations. It's a global platform, so nearly 70% of our revenue is international, and we have customers in over 50 countries. I would like to begin firstly by summarizing the financial performance of Q4 FY23. To set the context, we have one business, one legal entity. So you'll not see terms like standalone or consolidated. All the numbers that I'll talk about is for the business overall. Revenue from operations for Q4 FY23 was 20.3 crore, which is a 19% year-on-year increase. Total income was 20.1 crore. Coming to profitability, EBITDA was 0.7 crore. Also to add, this EBITDA includes all the non-cash expense like the ESOP charge, etc. PAT for the same period was 1.2 crore. Moving on, EBITDA margin was 3.4 crore and PAT margin was 6.1 crore. Sorry, 3.4% and PAT margin was 6.1%. To summarize the financials for the financial year FY23, revenue from operations was 78.1 crore, which is a 23% year-on-year increase. Total income was 81.2 crore, which is a 25% year-on-year increase. In terms of profitability, EBITDA for FY23 was 2.6 crore. PAT for FY23 was 5.3 crore. The PAT that you see in the audited financials is higher of about 33.1 crore. This is primarily due to the recognition of deferred tax assets of about 23 crore. And a write-back of IPO expenses, which was previously expensed and reimbursed to the company during this period of about 4.5 crores. Hence, you should exclude that. So the EBITDA and PAT numbers that you see in this slide, as well as in all the subsequent sections, have been adjusted for this deferred tax and IPO reimbursement. Also, please note that the bottom line numbers includes all the non-cash expenses as well, as mentioned earlier, including things like ESOP charge. Moving on, the EBITDA margin for the year was 3.3%. PAT margin was 6.8%. The other interesting aspect of the business is that it also generates free cash flow, which has been increasing. In FY23, the business generated positive free cash flow of 11.9 crore, which is an increase of 143% on an year-on-year basis. Cash and cash equivalents stood at 60.3 crores, which is an increase of 32% on a year-on-year basis, or an increase of 14.5 crore on an absolute basis. In the subsequent slides, I'll be covering each of the matrices we talked about in the summary in more detail, starting with revenue. revenue from operations is essentially revenue from platform subscriptions. 100% of this revenue is subscription-based. There is no services or one-time implementation component. So this is fairly high-quality revenue. Also, please note that this is accrued revenue. So though we do prepaid billing and collections, like most of the financial data platforms you may have seen, we only recognize revenue for the time duration falling within the reporting period for which the services was made available. As discussed earlier, revenue from operations in FY23 was 78.1 crore, which is a 23% year-on-year increase. Total income was 81.2 crore, which is a 25% year-on-year increase. We've also added the historical data for the last 3 financial years for your reference. EBITDA for the financial year was 2.6 crore. If you exclude the non-cash ESOP expense, this increases to 8 crores. This 2.6 crore EBITDA is an increment of 4.5 crore on a year-on-year basis. That is from a negative 1.9 crore to positive 2.6 crore. In terms of margin, the EBITDA margin for FY23 was 3.3%. This is an expansion of 6.3% on a year-on-year basis. So this continues to be an interesting aspect that you see in our business, which is the margin expansion that happens. On similar lines, PAT for the financial year was 5.3 crores. If you exclude the non-cash ESOP expense, this increases to 10.8 crores. This 5.3 crore PAT is an increment of 5.7 crore on a year-on-year basis. That is from a negative 0.4 crores to a positive 5.3 crores. In terms of margin, the PAT margin for FY23, as mentioned earlier, is 6.8%, which is an expansion of 7.4% on a year-on-year basis. One of the key reasons for this margin expansion is that significant part of the incremental revenue goes to the bottom line. To be specific, if you look at the revenue from operations for this year and compare it to last year, we added an incremental revenue of 14.7 crores. Out of this, 31% or 4.5 crore went into incremental EBITDA. Again, this is not one-off. Even if you look at the last 2 years from FY20 to 21, 84% of the incremental revenue from operations went into increased EBITDA. And from FY21 to 22, 77% of the incremental revenue from operations went into incremental EBITDA. Right? So to summarize, since the cost to serve incremental customer is limited, a significant portion of the incremental revenue goes into bottom line. The exact percentage of this may vary across the periods, primarily based on the investments across various growth initiatives that is done during those periods. Coming to expenses, our total expense for FY23 was 75.7 crores. This is a 16% increase over previous year. If you see, this is higher than what you would have seen in the previous year, primarily because of some of the growth initiatives that were done during this period. We believe that this will help us accelerate revenue growth in future by helping us expand our sales effort, as well as penetration within certain customer segments. I'll cover this in more detail in the subsequent slides. On the right-hand side of the slide, we have given the expense take-up of this cost across the key components. The key components are the same as what you would have seen in previously. Just to summarize, first, bulk of our expense is team cost. So in FY23, 88% of the total expense was in this head, which has been in the similar range in the last 2 years as well. So in FY21 and 22, this was 88% and 89% respectively of the total expense. Also to note, all our team is in-house, so there is no outsourced or contract workforce. The second largest item is cloud hosting, which accounted for 3.3% of the total expense, as we do a lot of data processing and analytics. This was followed by rental expense. The other interesting aspect is that we do not have a large paid marketing line item because we don't have large paid marketing spend, neither digital marketing nor offline based, typically required for customer acquisition. The reason for this is that because we are a data company, we produce a lot of content and hence are able to use a lot of that to generate organic traffic. So we are able to get leads fairly efficiently, which is also reflected in our expense. Going deeper into expense, this time we have also given the cost bridge of FY23 as compared to the previous year. The key drivers for this and what to expect going forward. To summarize, the total expense for FY23 was 75.7 crores, which is an increase of 10.2 crore over previous financial year. The key components of this cost bridge are the following three. The first is the employee expense, which increased by 8.4 crore over last financial year. This was primarily due to increase in headcount for various growth initiatives. Average headcount for FY23 was 23% higher than the previous financial year. Second, we saw an increase of 0.6 crore in the rental expense on account of employees returning to office. And lastly, the remainder 1.2 crore of the cost bridge increase was due to other expenses comprising of compliance and governance related costs post-listing. Going deeper into the first component of the cost bridge, employee cost for FY23 was 67 crores, which was higher by 8.4 crores from the previous year. The main driver for this, as mentioned, is the increased headcount due to various growth initiatives undertaken this year. On the right-hand side, we have given the average headcount across the last year, as well as the 4 quarters of the current financial year, of the last financial year, I'm sorry. So to see, the average headcount increased from 684 in FY22 to touching a peak of nearly 900 in the last quarter of FY23. And this is the same trend that you see in the total employee expense across the 4 quarters as well. To give a sense of what to expect going forward, most of the sizable step up required has been done. So for the upcoming quarters, the headcount increase that is expected is much lesser than what you would have seen in the previous couple of quarters. Additionally, we are also seeing this headcount number getting optimized due to various automation and efficiency initiatives. So in April of the current financial year, the average headcount decreased to 837 and the ending headcount was down to 822. So though the employee expense may not decrease to the same degree as the headcount, but you can expect the upcoming increase in this expense line item would be much lesser than what was seen in the previous couple of quarters. Moving further to the 2 remaining items, components of the cost bridge. The second was rental expense, which increased from 1.2 crore in FY22 to 1.8 crore in FY23. You can see that the quarterly expense, the trend which has been mentioned on the bottom, the increase has been primarily due to the capacity expansion on account of employees returning to office. Going forward, the rental expense is expected to continue to be in the same range as in the exiting quarter, as we don't have any further immediate capacity expansion planned. The remaining 1.2 crore increase was due to other items like compliance and governance related costs and other expenses. So to summarize on what to expect in terms of the total expense increase, since most of the non-linear step up that was required has been done, both in terms of headcount as well as other expenses like rental, the expense increase in the upcoming quarter should likely be lesser. Hence, as we mentioned also in the last call, that we expect bulk of the incremental revenue to continue going into bottom line within the next few quarters. Moving to revenue growth, we have given more color this time around the growth drivers and other initiatives that we are doing. Starting with revenue bridge, to help you understand the components of the revenue growth, we have split the revenue into revenue accrued from new and existing customers. To add, revenue from new customer is essentially revenue from customers that had accrual for the first time in that particular financial year. And revenue from existing customers, as the name suggests, is revenue from all other customers that was acquired previously. So coming to the right-hand side top chart, revenue growth from the existing customers. So one of the advantages of subscription business is that bulk part of a given year's revenue comes from customers that have been previously acquired without incremental sales effort. Additionally, a part of the growth also comes from the existing customers. The growth from existing customers from us primarily happens due to expansion in terms of number of licenses or seats. Typically, an account starts with smaller sets of licenses, say 2 or 3 licenses, and then grows over time. Even if you look at our average realized pricing, it is close to 6.7 lakhs per account per year, while we have multiple customers paying us also more than 40 lakh annually, right? Primarily based on user expansion. So coming to numbers, in FY21, the total revenue from operations was 43.8 crores. This set of existing customers contributed to a revenue of 50.7 crores in the subsequent financial year of FY22, which is a growth of 6.9 crores. On similar lines, in FY22, the total revenue from operations was 63.5 crores. And this set of existing customers contributed a revenue of 64.9 crore in the subsequent financial year of FY23, which is a growth of 1.4 crores. If you see the market conditions also during this period of FY23, this was marked by a decline of nearly 50% in terms of the global funding dollar deployed. And I'm sure you would have heard a lot about funding winter being talked about from the last couple of quarters. So though the funds were sitting on an all-time high or nearly high levels of dry powder, they were going slow on new investments. Moving to the chart on the right bottom, it shows revenue from new customers across the 2 last financial years. Interestingly, despite the market conditions, our new acquisition was at an all-time high, higher in FY23 as compared to FY22. This is primarily due to two reasons. One is that the addressable market is large, so there's a lot of latent demand which exists. Second, the other is that we have also been investing aggressively in our sales and marketing initiatives. We expect both these buckets of revenue to accelerate further as the markets improve in the next couple of quarters. Coming to some revenue metrics, we have given 2 new sets of revenue metrics for revenue and client growth. On the left-hand side, we have shared the number of accounts which gave us a revenue of more than 20 lakh, 30 lakh, 40 lakh across the last 3 financial years. So if you see, the number of clients grew consistently across all these 3 buckets across the last 3 financial years. It is also interesting to see that despite the market conditions during the last financial year, large accounts have continued to grow for us, also indicating the fact that there's not much pricing pressure that exists in the market and customers are willing to pay more if you deliver value. And also there's continued headroom to grow the average realized pricing. On the right-hand side, we have shared the split of revenue across the 4 geographical regions, which are India, rest of APAC, EMEA, and Americas. In terms of revenue contribution, FY23, India and Americas contributed to nearly 30% each. EMEA contributed to 27%. Rest of APAC contributed to the remaining 10%. In terms of growth, India and Americas grew at nearly 30%. EMEA was the slowest as compared to other regions, growing at 8%. Also moving towards volume growth, the number of accounts ending Q4 were 1,230. If you look at the incremental accounts added, it has been improving on a Q-on-Q basis, with Q4 being higher than the last 2 quarters. I will also take a couple of minutes to talk about some of the recent growth initiatives we have been aggressively working on, and I'm very excited to share the results that we've also been seeing from them. One of the very interesting growth initiatives is scaling our organic traffic. So because we are a data company, we are able to use a lot of data that we own to launch large set of public pages which generate a lot of customer traffic. For instance, someone is searching for, say, fintech companies in Sweden or SaaS companies in California. They come across our pages and we are able to generate leads through that. So if you look at our organic search traffic that we got across all our pages, so this was nearly 9 million in FY23. The current run rate is even higher, of about 15 million annually. So 3 interesting things regarding that. One is that this is a large traffic funnel that we've been able to build. Second is that this has been growing rapidly in the last few quarters, right? For instance, if you take the current run rate, it is more than double of what it was just 18 months back. Third, we continue to work on this aggressively, and we expect it to increase even further. The other interesting growth initiative is press mentions. As we have mentioned previously, whenever media talks about data on private markets or startups or emerging technology sectors, we want them to quote data from Tracxn. Our recent initiatives like launching reports with media, data contributions, regular columns in some newspapers, etc., have resulted in a multifold increase in press mentions that we have received across various respected media outlets. Advantage of press mention is that a lot of people discover our data for the first time through media and then come to our website and generate a very high intent lead. Also, we believe that this goes a long way in building a brand as a data company. It also helps our sales conversion and helps our revenue growth. Another interesting growth initiative that we mentioned about earlier on the data side is that we are expanding coverage in financials and cap tables data sets on private companies on platforms. For context, today we track financials of private companies across 15 countries and cap tables across 10 countries. These data sets are particularly in demand by certain customer segments like private equity and investment bank, among other segments. For illustration, an investor is looking to scan an upcoming space like single specialty hospital chains or a D2C or an internet first brand in a particular country. And in addition to the interesting companies and market landscape, they would also like to find the ones which are, say, more than 50 crore of revenue scale. Since we now have sufficient cash flows, we can invest in increasing the throughput of these data production engines. We believe that this will help us accelerate revenue growth in future, particularly in the customer segments of private equity and investment bank. Moving to some other financial metrics. Interestingly, despite these investments in various growth initiatives, the company generated positive increasing free cash flow and also increased cash and cash equivalents, both on a year-on-year as well as on a sequential Q-on-Q basis. The company generated free cash flow of 11.9 crore in FY23, which is a 143% increase or an increase of 7 crore from last year. Cash and cash equivalents is 60.3 crores, which is an increase of 14.5 crore or an year-on-year basis. We've also added the data for free cash flow for the last few years, and you can see that this has been consistently increasing across the last 2 years as well. In the subsequent slides, we have covered some of the other KPIs for the business. In the first slide, we covered the number of customer accounts, number of user accounts. So we closed March 23 at 1,230 accounts and 3,420 users, which is a 13% and a 10% year-on-year increase respectively. Please note here that there's some difference between number of users and the number of paid licenses. For instance, if we do a cleanup of some of the old non-paying customers of paid accounts, it reduces the number of users but does not have impact on the revenue. Right? In fact, it also helps us in sort of upselling to some of the accounts. Additionally, we also plan to add the data on number of licenses soon. In terms of the other KPIs, contract price or invoicing amount for FY23 was nearly 82 crores, which is an 18% year-on-year increase. The last graph talks about the number of entities profile, which is a proxy to the amount of data added on the platform. So today we track more than 2.1 million profiles, including private companies, funds, etc., globally. In terms of some other interesting characteristics of our business, so 68% of our revenue for FY23 was from outside India. It has been in the similar range of about 70% across the last 3 financial years. These customers span over 50 countries. The top 5 countries within this show a similar spread to where you have large corporates as well as private market investors. The top 5 countries for us by number of customer accounts are India, US, Singapore, UK, Germany. Additionally, we also serve a very diverse and rich customer segment across the investment industry, including venture capital funds, private equity funds, investment banks. as well as corporates across M&A teams, innovation teams, etc., and others like government agencies, universities. This also gives us a very large addressable market to tap into. I also wanted to take a minute to talk about some of our generative AI initiatives, and I'm sure you would have heard a lot about it recently. It has interesting applications for many businesses in general. Our aim is to be also pioneer in using generative AI as a technology company, both on the front end for the users as well as on the back end for our development and operations. So we've listed down some of the projects we are working on currently, which spans across the user-facing ones, right? Making it easier for users to query and get results. Or in other words, they should be able to access a lot of our data through chat interface, as well as on the backend ones, which is on the backend ones, which includes those for our production as well as for our operations. This covers most of the key business updates from the recent period. In the subsequent slides, we have covered the business overview. I'll skip going over these slides, but feel free to please check it offline. Additionally, we have also given a detailed financial statements, which people can also go through for more details. And that's all the key items that I wanted to share. I'll pass it back to Siddharth for any Q&A that the group might have.
Yeah, thank you, Neha, for the wonderful presentation. So requesting the audience, if anyone wants to ask a question, please use the raise hand option, or you can also put it in the Q&A box right at the bottom of your screen. I think I have the first question from Nikhil Chandak. Nikhil, please unmute your line and go ahead.
Hi, can you hear me, Siddharth, now?
Yeah, perfect, Nikhil. You can go ahead.
Yeah, perfect. Yeah, hi, Neha. So, my question was on the last part, which you covered on the generative AI aspect. Now, I'm just trying to think, as AI develops more and more over the next few years, how big a threat is, that AI, for the Tracxn business, as in, instead of paying Tracxn an annual fee, somebody could be using a free open source AI tool, say 2 years, 3 years down the line. And, that may really impact the revenue which you get from a customer, because he may have a free AI tool to use, open source tool to use after 3 years. So how do you address this, and how big a threat do you think this is to the business at large?
Yeah. No, sure. Thanks, Nikhil. So actually, we don't see this as a threat. Actually, we see this as a great opportunity for us to be able to use it and leverage it for our business. To give you a small example, right? Today, we have we are a company based out of India, but we track information about private companies across 50 different countries. We have customers in 50 different countries. For instance, we are able to help funds in Germany find out German-based companies through the platform, or funds in UK get local companies through the platform. We have been able to do this because of technology, right? Because technology has allowed us to be able to do this. Secondly, for instance, we track a lot of regulatory filings, which is in non-English language, right? Which is in the local language. We are able to standardize it, assimilate it, parse it, and make it very actionable, insightful for our end users, right? So this has all been possible because of technology. So we see it as a great enabler for us to be able to continue to build a global data platform. And I don't think the customer segment that we serve, just like in public markets, there is a very structured information. In private markets, there is even more unstructured information that is available. So I think this will help us, build more of a powerful company. And I think that is why we are also very excited about all these developments that is happening. Hope that answers the question, Nikhil.
Yeah, no, you have a fair point. It's just that, the situation today and few years down the line might be very different, the way the technology is really evolving. And, which is why this question keeps coming again and again. Nevertheless, the other thing I wanted to check is, would you look to also expand onto the listed side? So, the platform obviously is most specifically oriented to the unlisted companies across the world. but to increase the monetization or breadth of offerings, would you look to go on the listed side as well?
Right. So currently we see a lot of opportunity in the unlisted space, both in terms of the customer segments. Like even if you look at our customer segments, there is across the investment industry, VCP, etc. There's corporates, which is a large portion which is using it for M&A or for their digital transformation needs. So this segment, and on the other hand, if you look at a typical LP allocation today, for most LP asset classes, between 10 to 15% is to private assets. So we believe that just as in the public market, there have been large companies which have got created. We feel that the private market is like a large opportunity, and it's a very unserved need. Right. So, and like even if you look at even though the markets were probably down this financial year, we have still been able to grow some of the large accounts. Right. So there is a payability as well which exists in this market. Right. So currently a lot of our modules focus around serving the private market and the corporate segments that we have customers in, and as well as continue to expand geographically. Thirdly, we have got some requests, that some of the data that, for instance, we track, we track your headcount data on a monthly basis, or a lot of other things which may also be relevant for listed players, or if you're a listed investor and if you want to look at large unlisted companies within that peer set. So we may have some of those modules, but I guess our core customer base who uses it for a day in and day out would be the private market and the corporate as a universe. And we think that in this market itself, we can create like a large company.
Perfect. Great. Thank you so much. I'll come back in. Thank you.
Thanks, Nikhil.
Yeah. Thank you, Nikhil. Next question is from Nitin Padmanabhan. Nitin, you can unmute yourself and ask your question.
Yeah, hi. Good evening, Neha, Abhishek. So just was curious. So this year, our revenue to EBITDA conversion was much lower than at around 31%. And I presume a lot of this is driven by the higher employee cost. Do you think this sort of reverts to around the 60-65% range, or one should sort of assume this to be lower? So that's the first question. The second is that if I look at the current quarter and I just look at the trend over the last 3 quarters, the trend in customer account growth seems to be quite nice. It seems to be on an improving profile. But what we have seen in the current quarter is that the realizations have sort of dropped. So just wanted your thoughts on how are you looking at realizations on a going forward basis? Are you sort of taking in lower realizations to get in more accounts, or how should we think about it on a going forward basis? Thank you.
Thanks, Nitin. So I'll just take the first point, which is basically what is the incremental revenue. So this year it has been 31%, as you are correct. And what do we expect going forward? So one of the reasons why we have also given the detailed cost bridge and how what are the key drivers for it, and you can also see that. So and we have also sort of mentioned that we expect that this should go back to more than the majority, that is more than 50% within a couple of quarters. And you can see some of the leading indicators of this from the cost bridge that we have actually shared. So for instance, from, just as the headcount trend, right? So most of the step up that we had, there were a lot of growth initiatives that we were doing, and some required a step up. One is in terms of the headcount, which increased. So the average headcount increased by 23%, this year versus last year. That was one. And then there was some other step up which was done, in rental, as well as some of the other compliance and governance costs. So most of the step up that we needed have been done. So that is why we expected the incremental step up that is required is much lesser. So it should be more, it will go back to the linear, sort of the increase. And you are already seeing that, in the headcount numbers, for instance. That is why we've also shared like the April one, which is sort of the indicator that, it's already sort of becoming, it's already getting rationalized. So that is why you would expect that this number should go back to majority. When I say majority, it's like more than 50% within the next couple of quarters, which is the incremental revenue going into bottom line. Right? So hope that answers the first question. Now coming to the second question, which is, sorry.
Yeah, sorry. So the decline in headcount that we have sort of shown on a closing basis for April, where is this decline happening in terms of the kind of people? That was the only thing I was keen on. And would that have any impact on the growth initiatives or the incremental account growth that we're seeing? Just your thoughts there.
Right. Yeah. So just to add to that, the headcount which increased was primarily, in addition to the other teams, was primarily across two main teams. One is your sales team, that we had talked about, the sales team expansion, and the other was in data operations, which, because we had sort of greater coverage of financials and cap tables, which is required for certain customer segments, which we believe which will help us increase the penetration within the customer segment. So basically, the growth was in these two different teams, and the headcount reduction was also actually in these two teams, apart from some of the other ones, primarily because whenever you do bulk hiring, it is typically followed by an optimization phase, because not everyone is able to become productive. So that is one. And the second thing is that we also continue to do some automation and efficiency initiatives, which helps us sort of keep optimizing the number of, for instance, headcount that is required per module, right? So that also gets optimized. So this headcount change does not have any impact on the revenue. In fact, we continue to sort of aggressively grow towards both increasing the top of the funnel as well as increasing the sales, the conversion part, right? So this actually does not have any impact on that. I hope that answers the question, Nitin.
Yes, it does. But just one data point as well. So we have the numbers for, let's say, in Q1 fiscal 23 on how the split between these various employee groups. If on an annual basis, if we could give that so that it's sort of for us to sort of compare, would be helpful.
Yeah, so I can give the numbers as on April end, which is the same, the 820 people that you see. The split across the departments that we had shown earlier. So the split with the current split looks like this. So there are about 90 people in tech and product. There are about 230 people in sales, marketing, customer success. There are about 450 people in analyst and data operations, and about 50 in business, in other business functions, right? So hopefully that gives you the same split at what we had given earlier.
Sure. Yes, it does. Thank you.
Thanks. And now coming to the second question, which is across the last quarters that you see, which is the customer increase that we have been seeing. So yes, the incremental customer has been increasing. In terms of the average realized pricing, if you look at last year versus this year, we've increased it marginally. So last year it was 6.5 lakhs. Today, this year it has been 6.7 lakh. Q&Q, there might be some difference. What is a trend? Basically, probably to expect. So in terms of the new customer acquisition, it will continue to be probably, we'll start with like a small seats, like 1 seat or 3 seats. So that will continue to grow smaller. On the other side, we're also working a lot towards increasing the number of seats within the existing organization. But my sense is that I'm not sure about how much change you would probably see. My sense is that it will probably be the ASP might remain in the same range. And obviously, we continue to aggressively grow on the addition of new customers. If you see the net account has been increasing, or even the deferred revenue has increased, so there we continue to invest.
Sure. I was just curious because bulk of the revenue is from existing customers, and a sequential annualized drop of 3.1% is what I was curious about. So the drop seems large, considering that the existing base is very large, and the new base is the new customers are smaller. So why does it really fall in a single quarter to that extent and lead to a flattish revenue? I just was trying to understand the dynamic there.
Right. So maybe you can probably annual may be better, more indicative. So annually, if you look at it, it has varied. It has increased marginally from 6.5 to 6.7. Maybe that is more indicative than than the quarterly.
Sure, fair enough. Thank you so much, Neha, and all the very best.
Thanks, Nitin.
Yeah, thank you, Nitin. Our next question is from Pradyumn Chaudhary. Pradyumn, you can go ahead.
Yeah, hi, can you hear me?
Yeah, loud and clear.
Yeah. So the first question is, what I see is during Q4, there's been a growth in customer accounts, even on a quarter-on-quarter basis. However, the revenue has stayed flat. So why is that so?
Right. So that is one of the reasons also in Q4 specifically that we saw, apart from the other ones, which is there is, there was some flux that was also there, initially, like if you look at Q4, it also had the SVB crisis, though it did not impact us directly, but some of the customers' portfolio company had exposure, so some of them were busy. So we saw some delay in sort of the renewal, which was happening. So if you look at it, some of the customers we got in a little later. So this is the same sort of the flux that we had seen when like COVID had just started, when there was some delay in sort of renewals or the customer onboarding that we had seen. So I think that was probably one of the things. We also we also saw some momentum in March. At the end of March, when probably things were sort of more this thing. That might be one of the reasons why you will see the ending customer. So the ending customer account would have done slightly different than the incremental, just the revenue increase.
Understood. And second, in the beginning of the call, you mentioned that due to the markets being not so good, some of the customers probably they didn't increase their investments towards platforms and stuff. So somewhere, do you think it indicates a slightly less essential nature of a platform? Because like if I were to look at the listed space and if a customer was using Bloomberg, so because the markets were bad, I do not see that customer getting like not renewing Bloomberg, right? So from that perspective, can you please answer that?
Yeah, sure. So actually, in terms of the essential, actually, if you look at our DAUs to MAUs, actually fairly high. So it is not something that people use it, on an annualized basis or something. This is something that people use on a daily basis. For instance, if you are a private market investor and you're meeting like 5 companies in a day, for every company you have to see what is the information about it, what is the competition landscape, who else exists in that market, what are the large global peers within that, more information about like financials, cap tables, shareholding, historical valuation, etc. So this is something that you do, every day. And most of our customers say that, they have this tab always open. So it's a fairly essential thing. It's a very high, DAU to MAU that is there. In terms of the that impacting market activity, so if you look at just the number, the dollar deployed, that was like 50% lesser. So it's just that the number of deals that people are doing, right? So how much busy they are, number of deals that they are working on was much lesser this year because of a lot of things which is also there. So what we hear from customers is that they're still sitting on a lot of dry powder which is there, but they're also waiting for like some valuation reset to happen or some things to happen, and that's why they're probably doing that. So so like one of the ways in which we had expanded a lot is basically based on the number of users, right? So if people are little lesser active, people are little lesser prone to sort of expand. But I think that was probably, we expected to be only sort of transient, and we expect that that should go back to a higher level soon. Hope that answers the question.
Yeah. And lastly, I just wanted a couple of data points. One was, as you alluded to, a high DAU by MAU. So if you can give us an idea of that. And secondly, the latest quarter's customer retention rate and the net dollar retention rate. These two questions.
Got it. Okay. So on the DAU to MAU, our DAU to MAU is fairly high. So nearly approximately more than 40% of the users log in every day, right? DAU to MAU is more than 40%. Weekly actives to monthly actives is more than 65%. So it's fairly high sort of engagement on both levels. That's on the first part. On the second part of customer retention, net dollar retention. So we have actually not gone into these matrices. We plan to sort of give more matrices. As you've seen, we have probably expanded the set of matrices that we have given. So we probably, plan to add this. We've given another set of matrices which is sort of helps to explain that dynamics, which is, your revenue from existing and the new customer acquisition, which also sort of people wanted to understand, that, how is the new sales sort of panning out versus the other one. So we have given that. We probably plan to give sort of more matrices around this going forward.
Understood. Thank you so much.
Yeah. Thank you, Pradyuman. Our next question is from Samir Dosani. Samir, you may unmute yourself and ask your question.
Yeah, can you hear me?
Yeah, loud and clear, Samir. Please go ahead.
Yeah, so thanks for the opportunity. So is my understanding correct that you said a lot of these customers that we added were at the end, towards the end of Q4? That is why revenue growth is not reflecting the kind of accounts growth we have seen. That's correct?
That is to some extent correct, yes.
Okay. And
That is
second,
also
when you
probably
look at,
reflected in some of the deferred revenue, etc. Yes, but yeah, go on, please.
all right. And second is when I look at NRR, right? So revenue growth from existing customers last year was 15%. This year it's only 2%. So what should we understand from this? And what would be the trajectory for, obviously this year was a much tougher year for your customer base. What should we understand where this number settles in the next few years? Thanks.
Yeah, so we expected it should be between those two. So it should, I think last year, 2022 was a bit higher than usual because of a lot of activity. And obviously this year was much lower. So steady state might be, somewhere in between those two numbers.
Okay. And also, if you look at customer additions, customer account additions has been much better and has been on the improving trajectory. From your pipeline, your conversation with your prospective clients, how should we understand this trajectory? Should this number keep improving for the next few quarters? How should we understand that number? Thanks.
Right. So on the customer addition, we definitely expect that that should increase because of like if you look at the new customer addition, both in terms of also the revenue that we are doing because of a lot of GTM initiatives that we have done. Today we are reaching out to a lot more people. A lot more people are coming into our top of the funnel as leads. Right, like just if you look at the traffic that we get, that has increased nearly 2x in just the last 18 months. Right, so we get a lot more leads today, across all our pages, and our sales conversion has probably, despite we have scaled the seat, the conversion has probably remained the same range. So we are able to sort of get more, reach out to more customers. So so both in terms of one is the new acquisition, sort of continuing to sort of increase, and hopefully the existing expansion also improves than what it was last year. We should see this number, continue to increase.
So Q3, Q4 is not seasonally strong. There's no logic as such, right? So it's just organic increase that we're seeing because of the market conditions improve plus our own actions.
Yes, that's correct.
Okay. And also, if you look at, and I think this question is somewhere answered, but if you look at customer user per account, right, it has gone down from 2.9x to 2.775 or somewhere around that. So is this a factor that new customers are opting for lower users at the start, or you're seeing existing customers also cut a number of logins? What is that a factor of? So if you can explain that, thanks.
Yeah, sure. So the new customer count, so I think it would mostly be the former, which is essentially a lot of the new customers, when they start, they want to start small. They want to start with like a 1 seat or a 2 seat, 1 license or a 2 license. And the other thing is that, you hope to continue to sort of, grow your existing customers. So I think primarily it might be that your mix of essentially, like you're seeing lesser upgrades in your existing, and then you are signing up new customers in your 1 or 2 seats.
Understood. So circling back to that, that question of, that a lot of customers have been added towards the end of the quarter. So that means the user, the revenue per customer account is just an aberration, and maybe may recover next quarter. So that's how we should see it, right?
Yeah.
Yes, there's
No
nothing
pricing has
else
been reduced.
that no pricing at all, and there's no pricing pressure that we actually see. So nothing else apart from that we see different in that sense.
Sure. Thanks for that, and all the best.
Thanks.
Thank you, sir. So that you are in.
Siddharth, you're on mute, I think. Yeah. So.
Sorry about that. Thank you, Samir. Our next question is from Miten Shah. Miten, you may unmute yourself and ask your question.
Hi, am I audible?
Perfect.
Yeah, thanks for giving me the opportunity. And first of all, heartiest congratulations to team on giving good set of numbers. So we hope we'll see some traction in the traction of share price tomorrow as shareholders. Okay. Now coming to the questions, the first thing, I'm talking on behalf of my wife, who is actually the shareholder. So pardon me for that. So the first question would be like, I would just like to know who exactly are peers of Tracxn in this industry, whether from listed or unlisted?
Sure. So we are in a vertical industry, which is different from horizontal in a sense that the number of players that we compete globally are only a handful. They are not like dozens, which you see in some of the other vertical segments like an HRMS or a CRM, which is there. For us, because we are in the private market, data business, globally there are only about 5 or 6 players that exist in that space, which includes all the other ones that that exist, like a Crunchbase or a CB Insights or a PitchBook, etc., which are primarily there in the private market data space. Having said that, I think there is fair amount of differentiation which sort of exists across a lot of the players which which are there today. I hope that answers your question.
Sure, thanks a lot. And is there any fair idea of what would be our market share amongst these peers, and are we able to
Right. So currently, interestingly, like nearly 50% of the customers that we acquire had started using the platform for the first time, when we get the stats from our sales team. So our current market penetration is single digit, right? And even if we like today, we are at 1,200 accounts, or typically, organizations that we work with. The addressable universe is of 100,000 or nearly 1 lakh, more than 1 lakh organizations. So we are single digit percentage of the market. Even if we grow to 5 times, we'll still be single digit percentage of the market, right? So, and most of the other players are also single digit percentage of the market. So, that is why, I think right now it's a fairly sort of unserved market as well.
Fair enough. Just one more question, if you don't mind. So, we hear a lot of recession sort of kicking in slowly in the US, and as we derive almost 30% revenues from the Americas. So have we seen any slowdown in fetching the new customers, or are there any retention of in the existing customer?
Right. No, so actually recession for us in our market, I think private market probably started about 3 to 4 quarters back. In fact, like we had got a question on recession even like in the quarterly call. So that is also so I think in our market probably started about 3 to 4 quarters back, just as it probably started in the public markets, end of 2021. Which is where it also started in the private markets, because they are fairly linked, right? So right now, I think that has already happened. So what we see from the stats is that at least if you look at the investment funding which is happening, it looks like the bottom is already past us, and it looks like the quarter, is becoming flat. The subsequent quarters are becoming flat or is looking to improve. We probably have to wait 1 or 2 more quarters to actually see. But, interestingly, despite all this, America still grew at nearly 30% for us, right? And, in addition to like India's, which is at 30%, so that continues to grow fast. Obviously, Europe was slower, but, I think probably what we get sense from, also the customer is probably the worst is sort of behind, and we expect things to, probably improve.
Perfect. One more last question, if you don't mind, if I may ask for. Yeah, we see an improvement in the free cash flow, year on year, and so is there any thoughts that whether this be used for organic or inorganic growth?
Right.
Is the company looking for any inorganic growth? And is there any dividend policy that the management has thought about?
Right. So that is obviously one interesting aspect of a business, that it generates, like, despite all the initiatives that we are doing, the business continues to generate increasing free cash flow. And even if you look at our cash and cash equivalent, it is increased both on a year-on-year basis as well as on a sequential quarter-on-quarter basis, right? So this is one interesting aspect because of the business nature. In terms of how do we plan to do that, so we haven't sort of formalized the policy, but it will probably be across all these things, across inorganic, continue to invest in organic, inorganic, as well as either doing like a dividend or a buyback. So probably it will be across these budgets. We haven't finalized the plan. We'll probably, whenever we do that, we'll do that. We'll probably also announce more about it. In terms of organic and inorganic, I think our current plan is to continue to show the margin expansion for the first couple of quarters, after the listing, which is one of the things that people really liked about the business. And obviously, we do plan to do inorganic expansion that might happen maybe like a couple of quarters down, because even if you look at financial data companies in the public space, they've been fairly acquisitive. Like if you look at all the large ones, they have been fairly acquisitive. So obviously this is some lever that we do plan to do that, but maybe a couple of quarters down.
Correct. But is the company eyeing presently for any strategic acquisition otherwise?
No immediate plan as of now.
Yeah. Fair enough. I mean that answers all the queries. Thanks a lot for answering.
Thank you, Miten. We have a repeat question from Bhargav Buddhadev. Bhargav, you may go ahead. Kindly unmute yourself.
Yeah, hi Neha and Abhishek, can you hear me?
Yeah, hi Bhargav. Yeah. Yes.
Yeah, so first of all, congratulations for the customer addition case. It has improved sequentially. My first question is, if I read the slide 16, is it correct that the revenue from the existing customer has gone up by 30% in FY23?
FY23, so it has gone up by 1.4 crores from existing customers. So the way to read it is like if you look at FY21, the revenue was 48.3 crores. I'll actually just go back to that slide. So the revenue was so the revenue was 43.8 crores in FY21, which increased to 50.7 crores, which is an increase of 6.9. The same, if you look at the trend in FY21, it increased from 63.5 to 64.9, which is an increase of 1.4 crores. So hope that answers the question.
So how should we read the 65 crores in 23 was 50.7 in 22? Is that correct, or is there something missing?
No, so the existing set actually changes. Like if you look at in FY23, all the customers that were in that also came up in FY22 and prior to that became sort of your existing customers. So that is why.
So your existing customer definition is about a year and more.
Yeah, so it's a new customer, essentially anyone that came in that financial year, which gave us revenue for the first time in that financial year, and existing customer is everyone else. Everyone who was onboarded before that year, before that period. Right?
And this increase in existing customer addition is primarily led by user base addition, or is it also realization led?
It is primarily led by the user that we increase in the customers.
Okay. So there's no realization pressure, right, on the existing customer?
There is no pricing pressure that is there. Like even if you look at the large customer accounts that we have, like if you look at the number of customers which are there in more than 20 lakh, more than 30 lakh, more than 40 lakh buckets, they've actually increased. So there's no pricing pressure per se that sort of exists.
And fair to say that going forward also, you are not seeing any price negotiation which is indicative of any pricing pressure?
No, so there is no pricing pressure that we see from customers. We are in fact also looking to, sell to a lot of large accounts, which is more users to begin with. So we are also doing a lot of those initiatives. So there is no So this is not something that we hear from the customers a lot.
And last question is, over the course of next 2 years, what is the growth which you see in your fixed cost, which is your employee and the fixed part in the other expenditure?
Right. So you can expect what it was probably, I think last year was a little bit of aberration in terms of the total expense. And you can probably see the trajectory which has been there earlier, which is more less than 10%, is what you can expect, on a steady state going forward.
And on your cash on the balance sheet, you mentioned to the earlier participants' question that you are not looking at any acquisition. So is buyback also under consideration, given that the stock price is also below the IPO price?
So I think both of these are, so in terms of acquisition, like immediately there is no plan. We do plan to do an organic expansion. I think we'll have to time out as to, when we actually do that. So secondly, coming to the buyback, I think we do, so I think we haven't finalized it, but, obviously this would be something which is of interest to us, but we haven't sort of finalized around, doing that immediately.
Okay. Thank you for your answers and all the very best.
Thanks.
Thank you, Bhargav. Our next question is from Ayush Vimal. Would request you to kindly unmute yourself.
Hi, Neha. Hi, Abhishek. Thanks for giving me the opportunity. I just have two qualitative questions on the business. The first is, over the last year, have you seen, emerging use cases for this database, going beyond the realm of private market investors who tend to be more cyclical with the, macroeconomic cycles? Have you seen corporations or banks or other organizations using this database more often? And if so, can you highlight what are the new emerging use cases that you see?
Sure. So I'll take this. So in fact, our customer base, if you look at it, actually you'll find it interesting that today corporates by revenue is actually equally large as compared to the private market segment. So when I say private market, it includes VCs, PEs, IBs, etc. When I say corporates, it includes the M&A teams, innovation teams, etc. of the corporates, right? So today, actually, by revenue, corporates are actually equally large for us, as compared to the private market, and we continue to actually have interesting sort of use cases within them. To give you a small, couple of examples within corporate, the ones which is there. So today we work with more than 70 Fortune 500 corporations. And a couple of the use cases are, as follows. So one is their M&A team. So M&A team is fairly straightforward. Anyone who's looking to do M&A investments, they use this. The second is your innovation team or your digital transformation team. So for instance, anyone who's looking to do vendor discovery, right? So you can, whenever you're looking to do vendor discovery for any of the emerging spaces, right? Like a bank is looking to find out eKYC vendors, or a company is looking to find emerging vendors within their industry. They are able to use our platform to do that. So that's another very large use case that we see. Plus, there is also other use cases, for instance, sales and marketing. So anyone who's looking to target the private market as a customer segment, they find our data very interesting. So we already have some customer segments for that use case, and we can actually go more deeper also within that. So actually within that also, there are fairly interesting use cases that we already see. And, once we have sort of sizable customers, we also invest in building more modules and data that they need.
Fair enough. The second question I had was, I observed a noticeable decline in the number of employees in the month of April. Do you see this? And data entry and entity profiling is a very, very manual process. Do you see this changing over the next few years to be a more automated process, which might involve a lesser number of employees?
Right. So two parts. So one is, the employee decline has been primarily in the same team wherein we had increase in the team. So it is still higher than what it was, 2 years back. But whenever you do a sort of a bulk hiring, it is also, not everyone is able to become productive, etc. So, that little bit of optimization happens. Coming to the second point, which is on just the, the data operations team. So actually, we do a lot of automation, at our end and across different data modules that is there. If you look at our breadth of data modules, it's a lot, right? Like for instance, like public market companies give you a fairly structured information about financials. Private companies, they have filings which is in PDFs or images across various languages, not just English, right? Like if you go to different countries, it's available in non-English language. So we are able to extract that information. For instance, we have financials in more than 15 countries, cap tables in more than 10 countries. We track companies in all these countries. And there are other data points that we also track, like even the press filings, transaction information that we track in a lot of non-English as well as English language countries. So there is a lot of automation that we have to build, right? Just the fact that we have 2 million entities, we added 400,000 last year itself, right? So that just is an example of, you require a lot of automation for this. Having said that, there'll always be a human in the loop curation that will be required. Like even if you look at the financial data companies, right? Like though the information is fairly structured in there, they also have like large data teams which exist. And private market, I think it's even more unstructured. So for us, I think we'll continue to have that human in the loop for all our data modules. What we have seen is actually the amount of supervision that is required or the curation that is required per data module reduces over time, right? So that is the efficiency and automation that brings in. So for instance, the number of people that was required to just capture the global transaction information, right? We capture global transactions, any funding round happening across all the countries. The number of people that would be required in that unit would have reduced what it was probably 2 years back. So that is the kind of efficiency that we keep working on. But at the same time, we keep constantly also launch new data modules, etc. So yes, there is a lot of automation that you'll continue to see, but I'll always, I think we'll always have this human in the loop also, which will exist.
Right. Now, just one more question. Are we even looking to expand, the breadth of services that we provide? For instance, we can provide services like expert services or tailored services to specific clients for a fee, and that might be very synergistic with our existing offerings. So is something like that on the cards?
Right. So we actually have a fairly rich product roadmap, and this is actually a result of the requests that the customer themselves have sent us. So for instance, we also have this service called My Analyst, wherein we get, about thousands of requests every quarter, which is, like people are looking at different sort of data points or different side of views or analysis that, that they want help on. And this also becomes a funnel for, module that we have to launch. So we actually have fairly rich set of modules, and we know a lot of things which people have requested, us, which we think that, which will help us in sort of like getting more deeper into the customer workflow and helping us increase the price point and the user penetration over time. So yes, so all these are part of the roadmap which is there.
And just one minor point, do we have IP tracking on the platform which prevents users, from using and sharing login IDs and using a single account?
Yes. So just like in your mail client, you are able to see that you're logged into sort of more locations. So similarly, we at the backend, because it's a cloud hosted, we are able to track the IDs of the devices which is there. We are able to get it at the backend, and this is also a way in which our team sort of helps to upgrade. So we allow a little bit of sharing. For instance, someone is using a laptop or a mobile or an iPad, etc. We allow them a little bit of parallel usage, and once it crosses a particular more location or different locations, then our team also reaches out to them, ask them if they want to buy more logins for the team members. So this is also something that we are able to track and also helps us in upgrade.
Thank you so much. That's it.
Thank you, Ayush. Now we'll take Pratyush's question, which is on the chat window. So I'll read it loud. This quarter, billing was only 22.4 crores, which was down 3% QOQ and up only 13% YOY. Why have billings been weak?
Got it. So actually, billings, if you look at it, I think even if you look at last year, it should probably have a similar one. Like it also, for instance, 80% of the revenue is from nearly existing customers, and there's a little bit of pattern which is there in terms of where you have some of the customer concentration. So I think that is a similar pattern that you would also see, even last year. Secondly, if you look at some of the other things, for instance, like the other things like deferred revenue, etc., have increased. So, I think contract price, might have some seasonality as you would have seen even last year. I hope that answers the question.
Fine. Now we take Nitin's question. So Nitin Padmanabhan, you may unmute yourself and ask your question.
Yeah, hi, am I audible?
Perfect, Nitin. Please go ahead.
Yeah, hi. Yeah, hi. Thanks for the opportunity again. Neha, from what I understood, the disconnect between customer growth and revenue growth was driven by two factors. So one is new customers coming towards the end of the quarter, and second, renewals also being delayed, which is possibly reflected in the lower revenue per customer. Is that understanding right? And if it is right, does it mean that the revenue growth should outpace the customer growth in the following quarter? Is that a fair understanding?
So yes, the first one is a fair understanding, which is basically some of just the timing of where the customers had sort of signed up. So that would be correct. In terms of what to expect going forward, so I think we may have to see, because I guess we are also working towards a lot of new customer acquisition, and that typically happens at a lower ASP than the other one. So going forward, whether historically, if you actually see, the revenue growth has been higher than the customer growth, so maybe it will come back to that same level, but I think we'll have to probably see.
Yeah, because I see a similar kind of thing that happened even in the past. So I'm just trying to correlate what really happened. So if you look at Q2 fiscal 22, you had the same thing, wherein in a quarter, the realized pricing went down by 5.8%, but the very next quarter it was up 7.4%. Is it because of the nature of renewals being delayed? Is that a large sort of variable within that, or and can a similar thing happen, or am I reading it wrongly?
So mostly when you acquire a lot of new customers, ASPs go down, and if you see some expansion among the existing customers, ASPs go up. So my sense is that as market opens up, and if we see some kind of, if people start buying more seats, then you will see ASP growing up. My sense is the ASP is not grown because people have not bought a lot more seats this in last few months.
Understood. And second, just your thoughts on EMEA. So EMEA has been sort of relatively weak for the year. So what are you seeing in that market, and what are your thoughts there?
So I think we have done a lot of growth initiatives. Some of them have not resulted into good results in Europe. So we are now doing some specific region-specific initiatives so that we get some new lead generation there. So I think we are working actively on EMEA or Europe specifically more aggressively now.
Sure, fair enough. Thank you, Neha. Thank you, Abhishek, and all the very best.
Thank you, Nitin.
Thank you, Nitin. Our next question is from Rohit Balakrishnan. Rohit, you may unmute yourself and ask your question.
Am I audible?
You're slightly on the lower side, but it's fine.
Okay, I hope this is better. So I'm this is like my first call, so pardon my basic questions. Typically, do you have a sense that, your customers, do they use products beyond, do they use Tracxn and let's say also use the other products that you mentioned, or is it like it's either between you guys or the competition? Can you just maybe give a sense on that?
Yeah. So actually, so when we acquire customers, nearly 50% of the customers that we acquire actually use only one platform, like, started using us. And then there's some, obviously, about 30% of the customers that we acquired are using more than one. So I would say bulk of the people are using probably one platform, and there are some people who use more than one. Having said that, currently the differentiation that exists, so it's not like to like, it's not just the same data sort of which exists across the platform. So there's a fair amount of differentiation which exists. Hope that answers your question.
Yeah. And I don't know if this is the right platform, but can you talk a bit about what are those differentiations?
So actually, if you look at our platform and quite a things that we offer, for instance, our coverage in emerging technology, that is much more deeper. If a large bank wants to figure out, okay, what is happening in fintech, what are the emerging areas, what is happening in, what are the eKYC solutions, if they want to go niche in a particular area, there's no other platform that sort of exists that gives you that level of information. Similarly, if today you want to figure out all the companies in D2C brands coming up, or so there's a lot of differentiation which exists. One is a whole sector-based coverage, which is very interesting, which private market investors really value. Second is some of the data points that we have, in terms of the cap tables, etc., that we do, that is fairly unique. There are a lot of other data points that also exist. We can just you can check out the platform, and then that should be very apparent of the kind of differentiation which exists.
Got it. Okay, fine. Yeah, thank you. That's pretty much it. Thank you.
Thanks.
Yeah, thank you, Rohit. Neha, we have, I believe it's our last question. It's on the chat window from Virendra Verma. I read out the question verbatim. I'm new to the company business, need to know how the data for companies is sourced globally and what are the costs involved to get this data?
Sure. So in terms of, so essentially we track private markets and anything that's relevant to a private market investor, corporates, essentially we track it on the platform. In terms of how we source the data, that's broadly divided into 3 buckets. One is your whole publicly available data. So just like, you're looking for any particular themes, like if you're looking at GRC software companies, or you're looking at kitchen automation companies, you'll go to a search engine, you'll search for a company, you'll get a set of results. So one is your whole publicly available data about companies, from their websites, etc. So we track more than 500 million entities today on the backend. So that's one source of information. The second source of information is the proprietary information that we build. So for instance, the whole understanding that, this company is into insurance tech, or this company is into an internet first bank, or this company is a single specialty hospital chain. So that whole taxonomy. So, out of the 800 plus member, we have nearly 90 member sector focus analyst team. So that's the second proprietary information that we build. The third is basically based on regulatory filing. So we capture, so just like, public companies have to do a lot of filings, even private companies have to do a lot of filings across all the countries, on transactions, on annual filings, etc. And we are able to track those, right, in a variety of like English, non-English language, in a variety of past as well as image format that is there, information. So that's the third source of information that we have, which is the regulatory. So these probably comprises of the 3 key sources of information. Coming to the second part of the question, which is the cost. So we actually have the whole stack. So we don't license the data. So in a sense that, our cost to source the data is fairly minimal. We spend a lot in processing the information, making it actionable for the end users. And that is also reflected in our P&L, right? So hope that answers the question.
Yeah, perfect. I guess all the questions are done and no more hands are raised. So, so with that, I'd like to thank the Tracxn management for giving us the opportunity to host the call. I'll now pass it on to Neha and Abhishek to give their closing remarks. Thank you very much.
Yeah, thanks, Siddharth, and thanks everyone for joining us today. I hope we were able to give you a good understanding of a recent business update, and we have also been able to address some of your queries. In case there are any follow-up queries, please feel free to reach out to us, any of us. I am at neha@tracxn.com, or you can reach out to Abhishek and Prashant, or you can write to our team at investor.relations@tracxn.com. Right? Thanks again, and hope you have a good rest of the day.
Yeah. Thank you very much, Neha and Abhishek. All the best to you.
Thank you. Thank you everyone for joining.
Thank you. Thank you.
Thanks.